What's happening in Japan? Japan is carrying the heaviest public debt load in the developed world. Its national debt stands at more than 260% of its GDP. That means the country owes more than twice what its people make in an entire year. Imagine earning $50,000 a year and owing $130,000 in debt with no plan to stop borrowing. That's where Japan stands right now. But unlike a person, Japan can't declare bankruptcy in the usual sense. And it's not panicking. So what's really going on? Japan issues government bonds to fund its spending. When no one buys those bonds, the central bank steps in. Japan has spent decades buying its own debt with money it prints. This is called monetizing the debt. It sounds reckless. But Japan has done it longer and more aggressively than anyone else. So far, it hasn't blown up, but things are changing. Recently, fewer investors are buying Japanese government bonds. At the same time, Japan is starting to raise interest rates. That's a major shift. For years, Japan kept its rates near zero to make borrowing cheap. Now the cost of borrowing is going up. This puts pressure on both the government and private businesses. And that pressure doesn't stay inside Japan. It spreads. When Japan raises interest rates, the entire world reacts. Because investors who borrowed cheap money in yen suddenly face higher costs. This can trigger panic selling in global markets. It's happened before. In 2000, in 2008, and again in early 2023. Each time, Japan nudged interest rates up. Each time, global assets dropped. Stock markets fell. Currencies shifted. Debt got more expensive. The pattern is too clear to ignore. So, here's the question. If Japan's economy looks so shaky, why hasn't it collapsed yet? Why does the yen sometimes even gain value? The answer lies in the structure of Japan's debt. Unlike Greece or Argentina, Japan owes money mostly to itself. Over 40% of Japanese government bonds are held by the central bank. Another large chunk is held by domestic institutions like pension funds and insurance companies. Very little of that debt is in foreign hands. So, when Japan pays interest on its debt, much of that money stays inside the country. It's like paying yourself rent. It looks risky on paper, but in practice it's been surprisingly stable. Still, nothing lasts forever. Raising interest rates changes the math. If Japan's debt is manageable at 0.5% interest, it may not be at 2%. A small rate hike on a huge pile of debt can create huge budget problems. The cost of just servicing the debt can overwhelm everything else. That's the situation Japan is now drifting toward. And here's where things get dangerous. When bond auctions fail, when nobody wants to lend to Japan anymore, the country either has to raise rates even more or print more money. Raising rates triggers market panic. Printing money triggers currency collapse. Either way, the outcome is bad. This is the tightrope Japan is walking. The world is watching. And the financial fallout could reach far beyond Tokyo. Is Japan's debt sustainable? Only if people keep believing it is. What happens if that belief breaks? The answer is not just about Japan. It's about your investments, your savings, and your financial future. Let's keep going. If thought for 8 seconds, the myth of national bankruptcy. Japan owes more money than any other rich nation. Yet credit markets still treat Japan as safe. How can that be? A country with its own currency can always print more. Printing covers interest payments on local debt. Most Japanese bonds sit inside Japan. The central bank owns a giant share. Pension funds and insurers hold much of the rest. Foreign investors hold only a small slice. Picture a family that borrows from itself. Dad writes IOU. Mom stores those IOU in a kitchen drawer. Interest payments circle back to the same household. Cash never leaves the home. Japan works much the same way. This setup changes normal rules about default. If outside lenders stop buying bonds, the central bank can step it in. It clicks a keyboard. New yen appear. Bonds get funded. Default avoided, but printing carries hidden costs. Too much new money weakens the yen. Imports climb in price. Savings lose real value. Trust can fade. Japan balances two risks: raise rates and face market stress. Print yen and face currency stress. The window to act keeps narrowing. Why can't every country run this model? It demands three conditions: global faith in the currency, a strong export base that earns foreign cash, central bank independence backed by deep reserves. Japan still clears those bars. Thailand in 1997 did not. Turkey in recent years did not. Those currencies cracked when markets lost faith. So is Japan untouchable? No. Belief holds the system together. Belief can change fast. Watch the bond auctions. Weak demand signals doubt. Watch the exchange rate. A sudden yen surge or crash tells a story. Follow real yields. If yields spike while the bank prints, confidence slips. Follow energy costs. Japan imports nearly all its fuel. A higher import bill strains the balance. The passive path tracks these signals for you. Consider your own playbook. Keep part of your cash flexible. Hold assets in more than one currency. Own productive businesses, not only paper claims. Limit leverage so a spike in rates cannot sink you. Ask yourself clear questions. If yen strengthens 20%, how do my investments react? If Japanese rates double, where will global money run next? History shows turning points. In 1990, Japan's stock bubble burst after rates nudged higher. In 2008, the carry trade snapped when yen soared. Each time, investors who prepared held their ground. This cycle will turn again. Will you spot the signal or chase the news after the move? The next section looks at the interest rate trap and why small hikes in Tokyo can slam Wall Street. The interest rate trap. For decades, Japan kept interest rates close to zero. Borrowing was cheap. Money was easy. That helped fuel growth during difficult times. But it came with a price. Low interest rates encouraged risky bets. Investors borrowed in yen and invested elsewhere. This strategy is known as the carry trade. It worked as long as rates stayed low. But now Japan is raising rates, and that changes the game. Even a small increase in rates has a huge effect. Because Japan's debt is so massive, higher interest means higher payments. Imagine owing $1 million and suddenly your interest rate doubles. You're not just paying more, you're drowning. That's what Japan risks every time it raises rates. And it's not just Japan that feels it. When Japan raises rates, global investors panic. They rush to unwind trades. They sell off risky assets. They buy back yen to pay off debt. This drives up the value of the yen, and it pushes down the price of everything else. Stocks fall. Crypto crashes. Real estate dips. All because the cost of borrowing yen got a little higher. This has happened before. In the year 2000, Japan raised rates. Soon after, the dot-com bubble burst. In 2008, Japan raised rates again. Months later, the global financial crisis began. In 2023, the Bank of Japan increased rates again. U.S. stocks dropped nearly 6% in a single month. These are not coincidences. Japan may be far away, but its money is everywhere. When that money becomes more expensive, everything shifts. This is the trap. Keep rates low and risk creating bubbles. Raise rates and risk popping them. There's no easy way out. Japan knows this, but it also knows that doing nothing isn't an option anymore. Inflation is rising. Investors are losing patience. Bond buyers want higher returns. And so rates go up. Each increase tightens the rope, and the next misstep might shake the entire global market. The question isn't if someone will fall. It's who falls first. The hidden link between Japan and US markets. If you're watching this video, there's a high chance you are not living in Japan. Then why should you care? Most people think what happens in Japan stays in Japan. That's wrong. Japan is one of the biggest lenders in the world. When interest rates in Japan are low, investors borrow yen and invest elsewhere. They buy US stocks. They buy emerging market bonds. They buy everything. Because yen is cheap. It's like free money. This is the carry trade. It works as long as Japan keeps rates low and the yen stays weak. But when Japan raises rates, that flow reverses. Investors panic. They unwind their positions. They sell assets to pay back their yen loans. This drives up the value of the yen, and it causes global markets to fall. Not just a little, a lot. It's happened before. It will happen again. The trigger is small, but the reaction is huge. In 2008, the yen surged 40% after Japan raised rates. That wiped out billions in borrowed money overnight. Many investors couldn't pay back what they owed. They were forced to sell everything. Stocks dropped. Housing crashed. Banks collapsed. And it all started with Japan. That's how much influence it has. The carry trade is not just theory. It's the quiet engine behind global finance. And Japan holds the key. Even Warren Buffett got caught in it. He converted profits from US stocks into yen, betting the yen would stay weak. But the yen got stronger. He lost value on the currency side. Even if the stocks rose, the exchange rate erased the gains. If it can happen to Buffett, it can happen to anyone. That's how powerful currency moves can be. And that's why Japan's decisions matter. A 0.25% hike in Tokyo can cause a 10% drop in New York. It sounds absurd, but it's real. Because money is global, and Japan is one of the sources. When that source tightens, everyone feels it, the US included. Because when money leaves the carry trade, it doesn't just disappear. It rushes back to Japan, and it leaves a vacuum behind. That vacuum pulls down prices, slows investments, and stirs panic. All from a single move in interest rates. Japan might not want to crash the markets, but it has the power to do it. And every rate hike brings that risk closer. The bigger game cooperation with the US-Japan doesn't operate in isolation. It's deeply connected to the United States. Politically, economically, and financially, the two countries work together behind the scenes. Their central banks coordinate more than people realize. Japan holds over $1 trillion in US Treasury bonds. That's not by accident. It's part of a bigger strategy. When Japan prints yen, it often uses those funds to buy US debt. That keeps US interest rates lower than they would be, and it strengthens the dollar. At the same time, it weakens the yen. This benefits both sides. The US gets cheap borrowing. Japan gets stronger exports. A weaker yen makes Japanese goods cheaper overseas. Cars, electronics, machinery all become more competitive. But that cooperation has limits. If Japan raises interest rates and stops buying U.S. bonds, the U.S. feels it. Rates in the U.S. may rise. Stocks may fall. Borrowing gets more expensive. That's why the timing of Japan's moves matters. Sometimes Japan delays a rate hike to avoid shaking global markets. Other times, it raises rates to support a U.S. plan to tighten financial conditions. They play off each other, not in secret meetings, but through signals, through bond markets, through currency flows. It's a dance. And right now, both countries are tightening. Japan is raising rates. The U.S. is keeping rates high. Together, they are draining liquidity from the global system. They are pulling money back. That forces other countries to adjust. Emerging markets lose investment. Currencies weaken. Debt becomes harder to repay. It creates pressure worldwide. This isn't just policy. It's a coordinated effort to control inflation, reduce bubbles, and shift capital. And the central banks are leading it. Japan's central bank might look independent, but it often acts in sync with the U.S. Federal Reserve. The two are aligned, especially when it comes to global money supply. So when Japan holds back on buying its own bonds, it's not weakness. It's a move. It lets bond prices fall. It pushes rates up, and it gives them cover to hike rates again, all while looking like a natural market reaction. But it's not natural. It's planned. This cooperation is powerful, and it has consequences for currencies, for inflation, for your investments. When both Japan and the U.S. tighten at once, the world feels it. That's the game they are playing. And everyone else is just trying to keep what it means for you. You don't need to live in Japan to feel the impact. You don't need to follow central banks to be affected. If you earn money, save money, or invest money, this matters. When Japan raises interest rates, global money shifts. That can make your mortgage more expensive, your stock portfolio more volatile, your retirement account more vulnerable. This isn't just abstract policy. It's your financial life. If you hold U.S. stocks, you're exposed. If you invest in tech, real estate, or crypto, you're exposed. Even your job could be exposed if your industry depends on easy money or global trade. Currency values affect prices. If the dollar weakens and the yen strengthens, imports get more expensive. Gas, food, electronics. It hits your budget. It affects your choices. This is why global finance matters locally. The ripple effect is real. If investors pull money out of U.S. assets to buy safer yen-denominated bonds, the U.S. stock market may drop. That includes your index fund, your ETF, your 400 won. Even if your stocks don't fall, the dollar may lose value, so your gains won't buy as much. And if Japan's actions trigger a broader correction, the whole market could slide. This happened in 2008. It happened in 2020, and signs are building again. You don't have to panic, but you do have to prepare. Start by knowing where your money is. Check your exposure to high-risk assets. Rebalance if needed. Watch the yen. Watch Japanese bond yields. They are quiet signals, but they speak loudly, because when money moves globally, it moves fast, and by the time headlines catch up, it's too late. This is why following the passive path means paying attention to more than just local news. It means understanding where risk begins. Often it's not at home, it's overseas. And right now, that place is Japan. How to prepare? Start with awareness. You can't protect what you don't understand. Know where your money is. Know how exposed it is to global markets. If you hold international stocks or funds, check how much is tied to currency swings. If you own U.S. stocks, ask how rising global rates might affect company earnings. Interest affects everything: borrowing costs, profit margins, consumer spending, and that flows into stock prices. Don't assume U.S. markets are insulated. They are not. Next, diversify. Not just across stocks, but across asset classes. Hold some cash. Hold some bonds. Consider holding foreign currencies or gold. When markets panic, liquidity becomes power. You want dry powder ready. Also, build a safety buffer. If your investments fall 20%, do you have enough time and income to recover? If not, adjust now. Reduce leverage. Cut risky bets. Focus on stability. Use trailing stop losses if you actively trade. Use dollar cost averaging if you invest long term. Both protect you from timing mistakes. And don't ignore currency risk. If the dollar weakens and the yen strengthens, your overseas investments can take a hit, even when they look fine in local terms. Watch interest rate trends in Japan. Watch bond yields. Watch central bank decisions. These are early signals. They come before the headlines, and they give you time to adjust. You don't need to be perfect. You just need to be ready. Because when markets move, they move fast. And if you're not prepared, you'll be reacting instead of deciding. Preparation means asking hard questions now. What if my portfolio drops 30%? What if the dollar loses 10%? What if I can't sell when I want to? If those questions scare you, it's time to act. You don't need to bet big. You need to survive the storm. And storms always start quietly. What's coming next? Japan has already raised interest rates multiple times. Each time, global markets shook. The first hike triggered a 6% drop in U.S. stocks. The second led to a 10% slide. The third caused a 20% correction and widespread panic. Now a fourth rate hike is approaching, and it could be the one that breaks the pattern or confirms it. Japan has signaled more tightening is likely. That means higher rates, stronger yen, and tighter liquidity across the world. It also means less cheap money for risk assets. Stocks could fall again. Real estate could slow. Debt could become more expensive, and the global economy could feel the squeeze. This is not about one country's decision. It's about timing. Japan's rate hikes align closely with major global market declines, not by accident, but because Japan is a funding source for the world. When that source dries up, leverage unwinds fast. That's when volatility spikes and opportunity appears, because every sell-off creates a moment to buy. The key is knowing when and having the cash ready to act. Watch for these signals: a failed bond auction in Japan, a sudden surge in yen strength, an unexpected policy statement from the Bank of Japan. These are early indicators. They come before the crash, and they point to where things are headed. Don't wait for the news. By the time headlines arrive, the move has already happened. Position yourself early. Be cautious when others chase gains. Stay patient when others panic. And prepare for the moment when value returns. That moment often comes when fear is highest. And right now, fear is building. Lessons from past crashes: the pattern is familiar. It started in 1997 with the Asian financial crisis. Most people blamed US interest rates or currency attacks, but the root was Japan. At that time, over half of Thailand's debt was borrowed in yen. When Japan pulled credit and raised rates, money dried up. Thailand's currency collapsed. Markets across Asia followed. Then came 2000. The dot-com bubble. Again, Japan raised rates. Money that had been borrowed cheaply rushed back. Tech stocks fell. Billions were wiped out. In 2008, the pattern repeated. Global markets were already unstable. But Japan's subtle rate hikes made leverage too expensive. Investors had to sell. Assets collapsed. And a financial crisis exploded. Each time, the story looked different. But the trigger was the same. Japan raised rates. Liquidity disappeared. Markets cracked. People focus on the US, on headlines, on politics. But the real signals are often elsewhere, in interest rates, in bond yields, in quiet decisions made by central banks. That's where crashes begin. They don't start with panic. They start with pressure. Pressure on borrowers, on funds, on valuations. Then something breaks. You don't have to predict the moment. You only need to know the setup and protect yourself. Study the past not to repeat it, but to recognize it. The same signs are flashing now, and those who learn from history won't be surprised when it happens again. Your passive path forward now you know what to watch. Start with interest rates in Japan. Track when the Bank of Japan raises or pauses. Watch how the yen moves. A strengthening yen means money is returning to Japan. That often signals weakness elsewhere. Next, check bond auctions. If Japanese bonds aren't selling, it means confidence is slipping. That's a warning. Look at US markets. Sudden drops often follow Japanese rate hikes. It's not random. It's connected. Prepare your strategy. Keep a portion of your portfolio in low-risk assets. Hold some liquidity. Be ready to move when assets drop. Not during the fall, but at the bottom. That's when wealth shifts hands. Avoid chasing high. Stick to fundamentals. If an asset can't survive tighter liquidity, it's not worth holding. Measure your risk. Limit exposure to over-leveraged sectors. Avoid companies that depend on cheap debt. Stay flexible. If conditions change, adjust quickly. Being right isn't the goal. Staying in the game is. That's how wealth is built through cycles, not guesses. Follow the signals, not the noise. The passive path is about clarity, not chaos. It's about long-term thinking, patient action, prepared response, and steady hands when others are shaking. There is no perfect timing, but there is smart preparation. This is your edge. Use it. The next financial storm may not start with a bang. It may start with a quiet rate hike in Tokyo. By the time the world reacts, the smart money will have already moved. Now you know what to look for. You don't need to predict the future, but you do need to prepare for it. Follow the signals. Stay calm. Think long-term, and protect what you've built. If this video helped you see the bigger picture, like it. If you want more insights like this, subscribe to the channel. Drop a comment below with your thoughts or questions, and share this video with someone you care about. Financial knowledge is worth more when it's shared. Good luck out there. Feel free to explore other videos on this channel for deeper strategies and practical tools. See you in the next video.